Good day, fellow investors. The final chapter of our margin of safety summary. And the question we are going to answer is how to invest your money. The answer of this question discusses what comes before buying a stock, deciding how you're going to invest. Are you going to invest in stocks? Are you going to have someone else manage your money? What are the alternatives for the retail investor in Seth Klarman's opinion? Now, we discussed a lot about investing, and Seth Klarman says that investing is a full-time job. I would respectfully disagree there because, yes, it is a full-time job if you discuss complex securities, liquidations, bankrupt companies, etc., all the things that Seth Klarman does, but I think that as a retail investor, we can do better and especially easier, much easier. What should an investor that has a life but wants to be a value investor, what should one do? If we just check the S&P 500, the top 10 positions or top 20, we know and we use most of those businesses. So we need to keep investing simple, because if we can keep investing simple, then I believe that we can have great returns over time. And we discussed here Google, we said price earnings ratio of 20, growth ahead. We don't know the future, but we know that it will be between 5 and 15%. And then you have to compare it to the price. What happens if it is 5%? To my investment, and what happens if it is 15%, and then you manage that over time. But it is a pretty straightforward situation, and the key is, as always, if the price goes lower, we simply buy more. That could keep investing simple for you. And it is always Google, it is about owning those businesses and just being ready to buy more if it goes lower. And therefore I believe that investing can be easy, and we don't have to go as deep as Seth Klarman goes. Actually, the easier investing is, the better it is. So if you follow 20 positions per year, I think that that is enough to keep things easy. Well, you work 40 hours a week for your money. You might want to spend the 1 hour a week to manage that money. So that is a minimum. And that's something also we do with our YouTube portfolio, which is an educational portfolio. But I firmly believe that just by following that, which is 2 videos a month, 2, 3, 4, doesn't matter, so less than an hour, you can find something that might fit your portfolio once a year. So out of the 20, let's keep investing simple. Out of the 20 that you follow, I'm sure that one will be a great buy at that moment in time. And then you simply allocate your yearly investment money to that one. Over 10 years, you have an amazing portfolio of 10 great, cheaply bought businesses, and I'm sure that you can be a great investor. Buying all 20, that is insane. Of course, it depends on what other opportunities you have, but just slowly and steadily buying great businesses and compounding, waiting for the right price is always the best investing. And I think a retailer can do that easily, as Peter Lynch says, no matter what Seth Klarman says. And the key, as I said, is to build a portfolio over time. And this can also be applied to the S&P 500. The key is that you dollar cost average over time, you buy every month, and you try to buy more when the world seems to be ending. And if you can do that, then you are a great investor. Of course, you buy a little bit less, but if you put it on automatic long term and you're happy when things go down, you have nothing to worry about your investing. And this is not in line with Seth Klarman, but yes, this is his job. 30 billion under management, 1.5 billion net worth. And of course, if you have 1.5 billion, then you take more care about that money and you're not depending on your job. So that is something you have to see how fits you. The next alternative are mutual funds. I added here ETFs because those didn't exist 30 years ago. So that's also something we have to be very careful with. I think that now with mutual funds, things are pretty easy. Vanguard, S&P 500, ETFs or whatever, if you just look at the expense ratio here, it is 0.03%. So you can just apply the strategy we discussed a moment ago, no fees, and over time you should do well. So when returns are down, you buy more, and that's about it. But you must not fall into the trap that ETFs and Wall Street is setting up for you. And just to read this from Seth Klarman, written 30 years ago, this is from ARC. I don't know why I put this. Any relation, any similarities to reality is just a coincidence, as they say in the movies. So, many highly specialized mutual funds, biotechnology, environmental, third world, have been established in order to exploit investor interest in the latest market fad. And that's how it usually goes. I haven't discussed ARC recently, but this is a video that I made at the beginning of 2021. So I think the warning there, my warning was clear, and we already know what happened since then. It was 142, now it is 36, because I was getting so many emails, Sven, we should allocate 10, 15, 20% of the portfolio to ARC here, because Cathie Wood was the best performing investor in 2020. That is something that we'll discuss a little bit later when it comes to evaluating performance too, but you have to see what best fits you. Now, there are other ways to invest: mutual funds, ETFs, and then you have to also see how and what they are doing, and the money managers, how they're investing. And the key is to understand how that fits you. The question, Seth Klarman says, do they invest their own money? If yes, that is already a positive. But in this world of huge compensations for YouTubers for this, even if you invest your own money, if the fee you're getting is much bigger than the money you're investing, then you're always incentivized to get that fee, not to manage your money the best you can or in the interest of the client. That's also something to watch. Are the clients treated equally is a question. Of course, you don't want to be a second-grade client. And is the manager managing too much money to manage it effectively? Berkshire, of course, the performance is lagging because of the size. And then you have to always ask, is the strategy that the investor is doing fitting your needs? And I think I fall into this category with my business. If you check my research platform, I've started now doing this thesis, selling them individually. So if you're interested in just reading one to learn how it works, you can check that. I'll be adding one every week or 2 weeks as I write them up from the research platform. Or you can simply follow everything, which is a subscription of $499 per year plus local taxes, depending where you are from. And then you have everything, all the reports and everything there for free, plus my portfolios that I manage for myself. And you have to see, I think, at least a year, you see what I do, how I do, and whether what I do might serve you over the very, very long term. So that's the key also that Seth Klarman says. You have to understand whether the strategy and the orientation is good for you, whether you have a feeling with that, and if yes, then that is something good for you. I am investing my own money, or will be starting now in January 2023, as I've taken a short break to clear my mind. All the clients are treated equally. I send an email when I do something, when I update. Am I managing too much money? Unfortunately, not, because I'm managing just my own money. And is the strategy good? I think you need to watch it for a year, and then you can decide whether it is something you'll follow for the next 20 or not. And then we come to the question of performance. Everything in investing is about performance. We like Warren Buffett because he's great, Seth Klarman because he did amazing over the last 40 years for his investors. So yes, performance, but then we have to ask the question, how much risk is taken? If you take too much risk, as Cathie Wood took crazy risks to just make it grow, then the result can be bad. So you must not measure performance on a year or 2 year, better over the long term, but you have to also ask, how is the manager and what he is doing compatible with what I am doing? So chapter 14, I'll be doing a top 10 insights that I feel I gotten from rereading this book. I'll see you in that video, and check if you missed something in the Margin of Safety playlist. I'll see you in the next video.